Hello traders. Today I will share a great tool in trading. That is the supply and demand indicator, which most professional traders use in technical analysis. This tool will automatically plot support and resistance areas on the chart, with relatively high accuracy. When the price crosses a zone, it will define that zone to expire and automatically delete it on the chart. And so, this tool will help minimize manipulation for a trader, especially traders who specialize in scalping. The supply and demand zone indicator is quite easy to use. Since supply and demand zones are basically support and resistance zones, you can use this indicator in much the same way. Price often hits the supply zone and bounces back down. And when it hits the demand zone, it bounces up. So, a trader could take advantage of this predictability and make trades off of it. The rule of trading supply and demand is to sell at supply and buy at demand. If you found this video helpful, please put a like and comment down below. And now we will do a backtest to see how this indicator works. Like I said at the beginning of the video, when the price crosses a zone, it will define that zone to expire and automatically delete it on the chart. The indicator will draw a new zone that is more in line with the actual movements in the market. Supply and demand is one of the core strategies used in trading. It focuses on the ancient laws of supply and demand and how price moves in a free-flowing market. The foundation of this strategy is that the amount of an instrument that is available and the desire of buyers for it drive the price. It identifies zones on the chart where demand overwhelms supply, the demand zone, driving the price up, or where supply overwhelms demand, the supply zone, driving the price down. Most supply and demand traders wait for the price to enter these zones, where major activities of buying or selling have taken place, before entering a long or short position themselves. It makes sense to buy at a demand zone and to sell at a supply zone, but keep in mind that fresh zones are more effective than retested ones. They can be used as entry zones for a continuing trend or as reversal zones for a changing trend. Trades can be made aggressively or conservatively, each with their own rules of entry and exit. Supply and demand zones are defined when an imbalance in the buyers and sellers occurs. An easy way to visualize this is by thinking of supply as a commodity product. Let's say oranges, and we can think of demand as shoppers. In the financial markets, the asset is the product and the rate value is the demand. If the price is cheap, it means there is more supply than there are willing buyers. If the product is getting expensive, that means there is more demand, buyers for less supply. The supply and demand concept is timeless. It will always be the simplest, most atomic way of explaining why price changes. This is because the market is the place where sellers and buyers meet to conduct the business of exchanging the product for cash. By understanding the supply and demand concept, it will be very simple to spot SD zones on charts. Although this would be a hindsight observation, it will give us a good hint of where to look for our trades in the future. It is key to understand that the theory of supply and demand Forex trading is based on analyzing and defining zones in the past. These zones determine where should we expect the price to react in the future. Okay, now you can download and try this interesting indicator. Please find the download link in the description below. If this video was helpful, don't forget to click like button and subscribe to TFL Trader channel to get more robots and indicator. Thank you for watching.